It's been a year since I started investing in Starbucks stock instead of buying Starbucks coffee.
A year?
$20 a week. Is that much or not too much? Was it worth it? Do I regret it? What kind of lessons do I learn from it? Come along, I'll show you everything. First of all, if you didn't see the initial video where I share the rationale behind buying Starbucks stock instead of Starbucks coffee, check it out right here. I will also put the link in the description below so you can check it out later. But long story short, an average Starbucks customer spends around $20 a week buying coffee and snacks and things like that. So I decided, what if I start investing $20 in Starbucks stock instead of buying coffee? Some investment platforms allow you to do fractional buys, so you do not depend on the actual stock price, and that allowed me to invest exactly $20 a week. By the way, for tax reasons, I didn't buy the actual Starbucks stock in US dollars. I was buying its Canadian equivalent listed in Canadian dollars. That's why the price is really different from what the actual Starbucks stock is worth. I also started investing $20 a week in Costco stock, and of course I will show you if it was the right decision. Stick to the end of this video, it's worth it, I promise.
We'll see about that.
So without further delay, here's the data I kept track of for the last 52 weeks. And here's the graph. The solid line follows the actual stock price, and the dotted line tracks the average price. Indeed, whenever I made a new purchase, the average price would change. When the actual price is higher than the average, it would bring it up. When the stock goes down, so does the average. This approach is called dollar cost averaging. It allows you to mitigate the fluctuations of the stock price, and it worked really well for me. Not just well, it allowed me to make profit instead of losing money. No, seriously, check this out. The stock price of Starbucks went really down in May, 20% down. I bet many investors panicked and sold, and lost money. I kept buying the stock at a 20% discount, which allowed me to lower my average price. In August, the price went back up and even higher. Before the drop in May, my average was $26.46. At the moment it went up in August, the average was $24.59. So after the price went back up in August, it was going up all the way till the middle of December, and then it dropped again. Not as dramatically, but still. Now look closely. I sold all my shares for the price of $26.28. A year ago, when I invested my first $20, the price was $27.25. So if I invested the whole amount of $1,040 in January, I would actually lose money. But since I was dollar cost averaging, and by the end of the year I came with the average price of $25.75, I made some profit. I sold all my stock for $1,070.90, making $30.90 on top of the invested $1,040. Plus, I got $11.84 in dividends, making the whole return $42.74, or 4.1%. Which is better than nothing, but not that much, I would say. Now let's see what Costco brought me. Same approach, dollar cost averaging for 52 weeks, $20 a week in Canadian hedged fund. Sold all my shares for $1,162.85, making $122.85 on top of the invested $1,040, plus 2.46 in dividends, making a total return of $125.31, or 12%. Much better, right? But hold on, what if I invested the whole $1,040 at the beginning of the year? $1,040 invested at 30.69 and sold at 42.35 would result in $1,435.13. $395.13 on top of invested $1,040, or 38% of total return, plus some dividend. With that in mind, we're coming to the lessons I learned during this year. The first lesson is dollar cost averaging works better than attempt to time the market. Yes, in case of Costco, investing the whole amount would work better, and I sort of lost money with dollar cost averaging. But in case of Starbucks, it really saved me from losing money. Also, check it out, Costco had its drop too. In July, it went 10% down. Are you sure you would have nerves to keep calm and not to sell?
Not so sure about that.
The second lesson, diversification is the key. Look, if I only invested in Starbucks, I would only make 4%. But since I also invested in Costco, that helped me to bring the overall return to 8%. However, it is still below the average that was brought to investors who invested in broad ETFs or exchange traded funds. Indeed, those ETFs, whether it's VTI, the whole market, or S&P 500 indexes, include not only Starbucks and Costco, but also Tesla that grew 65% last year, or Nvidia that grew almost 190%. Not only those, of course. Those ETFs would include other companies with smaller returns, but that's the whole idea behind buying ETFs. Since you never know which company is going to perform well and which company is not, it's much better and it's much safer approach to buy them all and follow the whole market instead of trying to guess which company is going to go high and which is not. Well, if you are not Warren Buffett, of course, but I bet you are not.
No, I'm not.
So the main lesson I learned in this year: ETFs and dollar cost averaging can build you a fortune. With that in mind, I started a new YouTube channel where I start from absolute zero and invest $100 a week. I invest in 3 ETFs and dollar cost averaging every month. So if you want to follow my journey and make it your journey too, check out this new channel. I'll put the link in the description below and let's build our wealth together. See you there.